Hello and welcome back to our second session on treasury products. In this session, we will walk through some very basic and background materials and then move on to the primary core of our course. If I go through the list of material that you should be familiar with when you move on and start presenting treasury solutions to customers, I think there are two topics that are of interest, primary interest. I think the first is volatility. So we spent some time on volatility earlier on when we were talking about the ranges in which prices move, and we also introduced the concept of trailing volatility. Earlier, as I said, there are two courses, the Quant Crash course and the Value at Risk course, that I'd recommend that you go through. Both courses are available in the free online edition as well as a fairly intense video-based exercise. The second concept is convexity. Now, convexity comes into play when you speak about options. So the primary concept that you need to understand is the relationship of convexity with volatility and optionality. I think this is a topic that is of immense interest, and if you're a trader or if you work with traders, an appreciation of this topic can actually help you save both your neck and your customer's life in the future. The third is product behavior across different markets. So, in the last part of our first session, when we spoke about how different products react in different scenarios depending on the assumptions used in the initial analysis and the recommendation, product behavior here refers to exactly that slide. So when you walk in front of a customer or when you sit down to sell a solution, if you prepared to explain to him the interaction and the impact of these three items, volatility, convexity, and product behavior across different scenarios, if he can understand that piece, then your job is a lot more easier. We also spoke about two types of customers in our first session. We spoke about customer A and customer B. Customer A is the informed, is the educated, is the prepared, is the well-researched, is a customer who knows exactly what he wants and is only looking for you for execution, not advice. And then there was customer B, who's reliant and dependent on your analysis and your recommendation, right? So if you could take a customer B and turn him into a customer A, this is something that's going to happen over a long period of time. It's not going to happen with just your effort. There is a lot of investment on part of customer that is required to ensure that he educates himself and is comfortable with both the markets and the people and the individual that he ends up dealing with. So the path that a customer B needs to follow to get to becoming customer A is the path that relates to understanding these four concepts, right? That's background material. From background material, we move on to the course coverage, the core course coverage in our course. The first is, we as I said earlier, that I want to work with fundamental models and the two examples that we were working with dealt with oil and gold, and most fundamental models are related or closely related to what we call relative value. How does this commodity relate and behave with respect to other commodities? The second most important piece, this is the piece where you come in as an analyst as well as a relationship manager, is portfolios and exposure. So if a customer has exposure to US dollar, if he has exposure to Australian dollar, if he has exposure to the Swiss franc, if he has exposure to the yen, if he has exposure to the euro, if a customer has exposure to these currencies, how well do you understand his business? How well do you understand the drivers of these exposures to suggest a structure that works for him? The last and final piece in our course coverage is limits. While we spoke about them very, very briefly in the introductory session, we will actually spend a fair bit of time in documenting and trying to understand what really drives limits and limit utilization. And the two tools that we've used that we've mentioned earlier are PSR and PFE. Right? So the objective of our course is we think we can do a better job of selling our products to customers if we understand some basic background material that was covered earlier, as well as some basic tools that we are now going to spend a fair bit of time on. So let's start with a basic background concept that deals with distribution and volatility. While we've covered this earlier, for the purpose of completeness and inclusion, let me just say that if I have a commodity, let's say this is gold, the price range for gold ranges from, let's say, about 1100 to 1900, right? And if I were to go out and say, what's the likelihood of me seeing 1900 versus 1100, I'd say the probability is actually quite low. Gold right now is at about 1650 and change. So the likelihood of seeing a price around 1650 is actually quite high, because this is where gold is, and prices may actually rise a bit till they actually get to 1900, or they may decline a bit till they get to 1100, right? If I were to connect all of these points, so each of these steps represents a probability, a likelihood that this price would be realized. If I connect all of these lines, I would end up with a distribution of probabilities, right? How thick this distribution is, whether this range is 800 to 2500 is dependent on the term standard deviation, sigma, vol, or volatility. These are all terms that measure or mention the same concept. From the point of view of our work, we need volatility, and we need to have at least some stable assumption of distribution so that we can suggest or determine or project or predict or at least share an outlook of prices. When customers come to us for solutions, what are they looking for? They're looking for, I have 10 million euros coming in next month, next week, next day. I'm worried that the euro will move up or come down, and depending on what my profile is, whether I'm buying euros or selling euros, I want protection that allows me to lock in. I like the rate that I have right now. I want protection that allows me to lock in the current rate, or at least restrict the amount of losses that I would bear if the euro decides to go through the roof or go through the floor. Right? That's what my protection. That's the protection the customer wants and needs when he comes and talks to us. So if that's what he's looking for, he's ultimately looking for a change in price. If he's looking for a change in price and you want to give him protection against a change in price, you need to have a very strong understanding of what is the range of prices that you're likely to see, and what is the probability or the likelihood of each of these price levels, both with respect to your model, the market's model, the intuition of market player, as well as the counterparties that you and your customer are going to deal with. This understanding, this knowledge is one of the primary tools. This intuition is one of the primary tools that you have to build to become an effective salesman, right? So the core concept is sigma, and we have a range of definitions that we use when it comes to sigma. The first is variance, that the expectations are not met. Standard deviation is simply the square root of variance. If you pick up a textbook on financial modeling or on quantitative mathematics that is written by a PhD, you will see that they use the word dispersion and diffusion rather than variance and square root, right? But that's just the way it is. Standard deviation is also known as volatility, which is the term that we use. If you work with traders on a regular basis, they use a short form of volatility, which is vol, which is not the same as volume. No, this is vol or volatility. And then volatility comes in two flavors. The first is implied vol. Think in terms of implied volatility. I have a product that, based on my historical or empirical or actual estimate of volatility, should be priced at $1. The market is pricing it at $2.5. The reason why the market is pricing at $2.5 is that my historical empirical volatility is at 10% per year. Market is using an implied volatility of 25%. This increase in market's assumption of what the actual realized likely volatility is going over the life of the contract is the reason why my model price is different from the market's price. So implied vol is the volatility at which my model price matches the market price, right? So that's implied volatility. Now, if you look at trading vol, what is trading vol? If volatility right now is at 10% and that gives you a price of 1, and the implied volatility is, let's say, 25%, and that gives you a price of 2.5. The question is, at what level of volatility are you willing to do a trade? Buy or sell? What's your comfort zone? If vol touches 30%, would you still hold this position or sell it and book a profit? If vol touches 5%, would you still hold a position, book it and sell it? So trading volatility is some indication, or is an indication of your comfort zone beyond which you would either exit a position or enter a position, right? And as I said earlier, there is an entire course that we've done that focuses on the relationship between optionality, volatility, and convexity. There is a write-up around this topic also on the site. I'd suggest that you look it up. In essence, what this basically means is that as volatility goes higher and higher, options become very, very valuable. And then there is a bias towards the upside rather than the downside, given how options are generally constructed. So that's all that I'm going to say now. Read about the subject. There is a lot of material available on the web also that talks about the relation between optionality, volatility, and convexity. It's a very, very important, very, very relevant point that you need to be very, very comfortable with if you plan on working in this space. All right. So what does volatility look like? What does vol look like? So what I've done here is to make things easier and simpler for you, is I've actually gone out and tracked daily price movements. So change in the value of gold, US dollar amount, from Jan 2005 to August 2011. So that's gold in USD. This is WTI, or oil prices in USD terms. And this is cotton in USD terms. So I've got three commodities. I've got gold, oil, so gold, oil, and cotton. Right? And if you see, you can see that, with respect to gold, the volatility is actually used to be reasonable till you hit Lehman and Bear. So about sometime about this time, prices started really rising, and then they were okay and stable, and then you had this huge spike. And I don't know what point of the year is this. This could very well be the collapse of euro last year, but I'm not sure. But anyhow, so what I'm basically seeing is that the range that I see here in terms of price movement is about plus and minus 5%, and this is what we call daily return. So this is a simple plot of daily returns. If you can calculate daily returns, all you need to do in Excel is take this entire series of daily returns and run the stdef function in Excel to get volatility, static volatility, or basic simple vanilla volatility. Same thing when we look at oil, about 5% initially, but then unlike gold, this has been fairly substantially volatile. It actually touches the 5% mark on a regular basis, and there are instances where it even touched 15% movement on a single day. Okay, and then finally we come to cotton. You find that it is the range. The original range is about 4 and minus 4%, and the overall range, hardly goes beyond 8% on the plus side and minus 8%. So these are daily returns, daily price movements in the price of three commodities for gold, WTI, and cotton. And the reason why I showed you this is that sometimes people feel that standard deviation, vol, or volatility is an abstract concept. It's difficult to visualize it. Well, that's exactly what we've done here for you. Here is a visualization of volatility. Volatility is not constant. Similar to the graphs that you saw earlier on the previous screen, here what we're doing is we're saying, let's plot trailing volatility, which is average volatility over a 10, 15, 30, or 60-day period. Let's plot average volatility. In this specific case, I think we're looking at 60 days of products across different markets. And the data set is a little smaller. We're looking at 28th March 2008 to April 2009. You can see that for grains and feeds, which is this line, vol went from about 4% to 10%, and then came down all the way to about 3%. If you look at crude oil, which is this line, there you go, that's crude oil, right? Look at crude oil, started off with about 2% and then touched about 6% and then came down to about 4%. If you look at refined products, which is actual petrochemical compounds, again started at 2%, went as high as 7%, and then came down again to about 4%. So one thing that is very, very obvious here is that, remember this, the lesson is volatility is not constant. It's not static. It moves, it changes. And if you have a product that's exposed to volatility, the portfolio value, the amount that you're in the money, the amount that you're out of money, the losses that you've booked against losses on that product portfolio will also move and change. They are not going to be static, they're not going to be constant. Take this lesson to currencies. So look at Australian dollar versus JPY, sterling versus JPY, USD versus JPY, USD versus the Australian dollar, and the euro versus JPY. And you can see that it's the AUD JPY pair which is the most volatile. That went from about 0.5% here to about 3.6%, about 7 times increase in vol. 7-time increase in vol over a span of, this is May 2008 to October 2008. So May, June, July, August, September, October, in 6 months. 6 months, vol moved by not 7%, 7 times. Went from 0.5% to about 3.6%. If you compare this with, let's say, the USD Australian dollar, that went from about 0.4% to about 2.8%. Similar size move. If you look at sterling versus JPY, went from about I'd say about 0.8% to here, about 2%. Right? So primary lesson: vol is not static. Doesn't just work. This relation is not just true for commodities such as crude, refined products, precious metals, fats and oils, foods, grains and feed, and fibers and textiles, but also works for currencies. Okay. Now, a second concept that is related to prices and price movements, which is important to our analysis and our work, is what we call the flight to safety concept. And the concept is that generally people buy safe assets when they want to be safe, but the problem with safe assets is that the yield is very, very low. So if you move on from safe assets to assets that give you a higher yield, yes, you add yield, but you also add risk. And as you add risk, your risk profile changes. Now, there is a challenge in the sense that when the cycle works, when you change risk profile when markets become more volatile, since a lot of risk limits are linked to volatility or standard deviation, or there's a concept called value at risk or VAR. Since all of this is linked to volatility, as your risk profile changes, you get more exposed to the fact that volatility in the market, in the underlying market, will hit your risk limit. And when this limit is hit, you have to close or cut or complete or finish or wrap up your positions, reduce volatility, and park capital. When it comes to parking capital, you will only park capital in safe assets. So that's this entire cycle is what we call the flight to safety cycle. I move from safe assets to riskier assets because I want to add yield. That changes my risk profile. When the markets become more volatile, then my risk limits are hit. I close my position and move to safe assets. How is this relevant to the work that we do? Risk assets are, the primary safe asset is the US dollar. So whenever there is a perception that risk profile is going to change, you will see an increased movement in the dollar, and the dollar should appreciate. Within the dollar, right now this is not true to some extent, but within the dollar, the primary asset that people invest in, which is liquid, which is secure, which has a reasonable store of value with respect to the US dollar, is the treasury bill instrument. So whenever volatility rises or jack up, you will notice that the dollar appreciates. Even though if the bad news is about the US economy, the dollar would still appreciate, and people would buy T-bills, which would push the yields on T-bills down on account of high demand. Basic concept, flight to safety. Commodities, the products that we work with, and a wide range of currencies, especially the Australian dollar and possibly the euro to some extent, are perceived as riskier currencies. So whenever people want to take risks, they may move from the dollar to the Australian dollar, or similar high-yielding currencies, or similar high-yielding commodities. They move from the US dollar to, let's say, a position in gold, or oil, or silver. But if these markets become volatile and the risk limits are hit, they will come back, run back all the way to treasury bills. How has this profile changed? I think over the years we've added the yen, and recently we've added the Swiss franc to the list of safe havens, though the volatility in Swiss franc and the battle between the Swiss central bank and a number of hedge funds who are betting on the peg that they've imposed on the value of the Swiss franc or CHF has made things interesting. But primarily, it's a safe bet to go out and say that when there is a flight to safety cycle, you will see capital moving back to the dollar and sometimes to the yen. How have these preferences changed over a period of time? I think if you look at these two graphs that we have in front of us, we have a weekly FX and commodity market parameter that shows up on Yahoo Finance courtesy of Fixed Investment Strategies. And within this, you can see that as far as February 2010 was concerned, the primary incremental impact with respect to increase in movement as well as value was with the Japanese yen. A week, 2 weeks later, 3 weeks later, when there was a significant crisis in currency market, it was again the yen that appreciated. And then if you look at now, which is, let's say, September 2011, both the yen, the sterling, and the euro have sort of lost their position or their place. There was already a movement away from euro and sterling, but the Swiss franc has gone up, gold has gone up, silver has gone up, and so has the Australian dollar. So this is a quick review of the commodities and the movement in markets with respect to FX and commodities, with respect to flight and safety cycle. All right. Now, how high can volatilities go? You again see three components here. You see WTI, you see Euro USD, and you see gold. And we can clearly see that as far as vol is concerned, the crude oil piece is the piece that we really need to watch out when it comes to volatility. Gold used to be stable, and Euro USD, because it's a currency, because you're looking at daily volatilities, the price change and the price movement on a relative basis is actually not that significant substantial. In the long run, though, it turns into a fairly large move. So now let's do a quick thought experiment. We spoke earlier about volatility, and we spoke about a concept called pre-settlement risk, or PSR. So what is PSR? PSR is, the concept is very simple. Let's say that I have agreed to buy gold from you. Right? Gold right now is at 1650. My concern is that gold will go all the way up to 2000. So I enter into a contract where I agree to purchase or buy gold from you at a price of 1750 at the end of 1 year. Right? That's the agreement. Now, as part of this agreement, I will buy, let's say, 10,000 or 1,000 ounces of gold from you. Right? So 1,000 ounces at 1650, which is the current market price, will give you 1650 and 1, 2, 3. Okay, so my deal is for about 1.65 million US dollars, if at current market value. If I purchase it from you at the end of 1 year, I will spend about 1750. Okay, it's about 1.7 million, 1.75 million US dollars. Now the challenge is, at the end of 1 year, if gold is at 2000, there is no issue. I will certainly go out and exercise this position because I'm buying something which is worth $2 million for $1.75 million, right? No brainer. But my problem and the challenge is, and my worry as a counterparty on the other side is that, if gold falls to 1,000 and you don't buy, I have an issue. My issue is that from my calculation, from my point of view, from my book, I've booked this position at 1750 1 year down the road. If you don't buy it, I have to sell this and book a loss of 750, because in the market when I go out and sell this, I can only get $1,000 for my 1,000 ounces of gold, right? So I immediately have a loss of 7. So my problem is that from a loss point of view, from an exposure point of view, from a credit risk point of view, I may lose $750 an ounce. Now, this is my credit risk or my credit exposure per ounce on this relationship, on this account. The question I want to ask is, if you default, when will you default? I will only default when I am out of money. I'm not going to default if I'm in the money. right? So if I'm here, if gold is at 2,000, I'm not going to default. I'm going to default when gold is 1,000. Right? So my second question is, if I'm going to default when I'm out of money, how low can gold go? What's the worst case value that I can see for gold in the next 1 year? How do I answer this question? The way I answer this question is I say, okay, let's look at vol and let's link or use vol to calculate what I call my worst case loss. What's my worst case loss? My worst case loss is if one standard deviation move in gold is, let's say, 10%, which means at 1650, I'm looking at a movement of plus minus 165. What's the absolute positively, negatively worst thing that can happen to me? And the absolute worst thing that can happen to me is, if I look at basic statistical models, if I assume normality of distribution, which is not necessarily true, I'm looking at maybe a move of 3 standard deviations. A 3 standard deviation move is simply 3 times 165. So 3 into 165 gives me 300 plus 180 plus 15, right? So that's how I add. So it's about 495 plus minus 495, which means that if gold is at 1650 right now, and I'm looking at a price decline of 495, then this gives me 5, this gives me 5, this gives me 1. So I'm looking at a price of 1155, right? That's my low case. So if I've agreed to sell at 1750 and you default, then I will only be able to sell this at 1155, and that's my credit exposure, right? That's my worst case. That's the worst that can happen. So I take the worst that can happen and find out and calculate my worst case move, which is a move of plus minus 495 depending on my position. I use this to find out, I use this and link this to my pricing model that comes out and tells me that, Jawad, your pricing model is set at 1750. In your worst case scenario, prices will fall to 1155, and the difference between these two numbers is your credit exposure, because that's what you'll have to cover yourself from the market. And then I take this and go out and calculate my default impact, which is what I've just done, and then I go out and give you my PSR. So this is my pre-settlement risk exposure, hence the term PSRE. Right? Did you follow that? So in simple terms, standard deviation and volatility gives me my worst case move, which gives me my worst case loss, which then gets plugged into my pricing model, which then gives me my default impact, which then gives me my pre-settlement risk limit, right? That's the thought experiment. Now the question, so now that's the background of a PSR. We still haven't done the thought experiment. Now the question I want to ask you is, when it comes to estimating this number, this volatility, what is the right number? You're going to do 30 days, 60 days, 90 days, 1 year, 3 year, 5 year, 10 years. And if you look at this, that's what I've done. I've said 2005 to 2011. That's the trend in gold prices. Earlier on, when you looked at one of the first few slides, we actually showed you trailing volatility for gold, right? So are you going to use this chunk or this chunk or this chunk or the entire chunk? And then if you take this analysis a little further, how long term is long term? So if I take those 5 years and I start looking at gold prices, I'm actually saying, here is gold prices from yes, that's right, that's 1972 to 2011. And here are gold prices from 1932 to 1972, and here are gold prices from 1932 all the way up to 1792. How long is long term? And how has the relative value model? So I'm not just looking at historical gold prices, I'm also looking at the gold to silver ratio. So the blue line in the specific case is the gold to silver price ratio. How long or how stable has the gold to silver ratio been? From 1792 to 1892, this 100 years, then 1892 all the way up to 1922, then from 1922 all the way up to the start of the Second World War, and then going all the way down to 1965, and then climbing up all the way again in the late 90s, late 80s, early 90s, and then coming all the way back down, right? So what is long term? And from the point of view, if your objective is to walk through this path from wall to var, from var to worst case, from worst case to pricing model, from pricing model to default impact, from default impact to PSR, what's your long range? How do you define long range? And again, as I said earlier, there has been a lot of movement, both in the underlying fundamental prices of gold, as we've seen, as well as in our relative value model. So there is no price stability per se, which leads to a very important question. That important question is that if this is based on this, so if PSR is based on volatility drives PSR, how frequently should you update your vol model, and how frequently should you update your PSR model? That's the question. Now, this used to be a moot point because people would calculate their PSR values and allocate them and build their credit policy document based on vol models that were updated once a year. I think recently we've started seeing a much more sensible approach, especially on the part of exchanges, as volatility has risen, as price levels have risen, where they've now started increasing margin requirements on a regular basis. So whenever prices move, volatility moves, there is a higher tendency on part of exchanges to go out and increase margin requirements, so that there is more cash that you have to put down on a table to participate, to speculate, and to create pressure on the market. This is something that was not there 20, 25, 30 years ago, but is now becoming an increasingly common occurrence on the part of exchanges, especially exchanges that deal with future contracts. All right. So while we've gone out and introduced the concept of PSR, how does this actually work? So we said vol comes from standard deviation. Value at risk comes from a VAR model. Again, there is a course on value at risk and volatility on crash course. Please go out and check it out. That's if this is something that sounds like Greek to you, I think there is a lot of material here and here that can help you out. VAR gives us a worst case move, which then gives us a pricing model, which then gets plugged into a pricing model, which then gives us a default impact, which then gives us our PSR estimate. Now, the process is the same whether you work with oil, with gold, with bonds, with currencies, or with equities. The structure, the calculation, the model will remain the same. The only thing that will change is the underlying data and the price series and the impact of margin requirements that you've added and allocated to these specific terms. The challenge, though, is, you've seen, I've gone out and shared a number of instances where you've actually seen the change in trailing volatility. The challenge, though, is that this policy document, and in a number of banks and financial institutions, this is called the credit policy document. This credit policy document is static. And the reason why it's static is that the data that's used to calculate both the limits and test the limits. If I run a treasury group, if I run a trading group, I get data, I update prices, I run models, I run calculations on a regular basis. In most cases, a CP document, a credit policy document, or an FI limit document, in most cases, this document only gets updated once a quarter if you're lucky. So your limits get revised once a quarter if you're lucky, or once a year if you're unlucky. So if you go back to the slides where we actually showed volatility and changes in volatility over a period of time, if your data and your process that goes out and updates the model and the metrics is not updated just as frequently, you are out of date. Your exposures are not being measured correctly. If a client goes under or defaults, when your model is still calibrated and configured to work at volatility at 5%, whereas market volatility has moved to 25%, you're going to lose your shirt. And I think that has happened frequently enough. I think one of the reasons why we see exchanges updating their margin requirements on a much more proactive basis is because this has happened far too many times now. Look at the structure: policy, data, models, metrics, limits, process, and control. If markets move on a daily basis, and especially if the movement that you see is more than 3% plus minus, then you need to run this entire process also on a daily basis. If you don't, you will have an issue. Now, almost all the work that we've done so far assumes that the foundation of the work that we've done is volatility and relative value and interconnections or relationships between markets and prices, right? Fundamental assumption that we made is that this is all stable. This is stable. So the entire pyramid of value at risk, of models, of process, of control, of limits, the entire model is based on this foundation. There is another assumption, obviously, and that assumption deals with distribution. What's the underlying distribution? Distribution, right? So this model is basically based on stability at these two layers. Now, the challenge is, you know it as well as I do, and I think the world has gone out and the markets have gone out and proven this enough number of times, that this is not true. So there are instances when people talk about what's the worst that can happen, what's the most that can go wrong. You'll find what's the worst that can go wrong. You'll find the worst that can happen is that this sigma AB, we know this as covariance, and another derivative form as correlation. This sigma AB breaks down. Right? Breaks down. That's the challenge. So your worst case nightmare is sigma AB goes away. Sigma AB goes away, this goes away. All of this goes away. Sigma AB goes away, all of this goes away. All of this goes away. Your models are basically standing in about 2 feet of air. And when you stand in front of 2 feet of air, this basically is dead in the water, right? No longer exists. So in terms of qualifications, I want you to appreciate and understand that your biggest challenge is that despite everything that we do, models will break down when markets are under stress. And you have to make sure that you've added this qualification both in your understanding, in your presentations, in your interaction with not just your board, but also the board of your clients and your customers. Right, so now what we've done is in the first session, we did a quick review of the 5 themes that are relevant to selling treasury products. In the next, we covered some very basic, very background material that dealt with actually looking and building a slightly deeper understanding of how the limit process works. We now need to move on to the exposure estimation piece with respect to a customer. This is something that we'll cover in our next session. For the time being, I hope that you've enjoyed the material that we covered so far and that this is relevant and useful. I appreciate the time you spent with us. This is Jawad Ahmed Fareed signing off for financetrainingcourse.com. Thank you very much for your time.